Here is something nobody told me before I started studying real estate. You see, 60% of homeowners in America right now are so on money. They did not even know they owned. Not because they bought too much house, but because nobody walked them through the real numbers before they signed. It does not hit in year one either. Year one feels fine. It's year two that gets people. When one letter from the mortgage company adds up $400, sometimes even $500 to a payment they thought was locked in. I'm going to show you exactly how that happens. And more importantly, 3 things you can check yourself before you even make an offer. And I bet with you, the third one is the most important. So you don't want to miss it. So your bank approves you and gives you a number. Let's say your monthly payment comes out to $1,400. Here's the thing. That number doesn't include what insurance is going to cost you. And insurance has been going up. In some part of the country, it's jumped to 70% in just 6 years. And that cost sit on top of your mortgage, not inside. So before you get excited about any number that banks give you, add at least 15% of it. You see, that cost, that's your real test. If $1,400 becomes $1,610 and that still works, okay, you're probably fine. But if that extra $210 makes things tight, you can't afford that house, the bank will still give you the loan. That part is on you and not the bank. There's an old rule that says save 1% of your home's value every year for repair. On a $300,000 home, that's $250 a month. The problem is that rule treats a brand new house and a 25 years old house the same way. They are not the same. Every home has 5 things that we eventually need replacing: the roof, the HVAC system, the plumbing, the electrical panel, and the windows. I call them the big 5. You see, when you are looking at any house, just ask, when was each of these last replaced? Same question, simple question. If 3 or more of them are either older than 15 years, you are probably looking at a $30,000 worth of repair coming at you within the next 5 years. That changes your budget. Add at least $300 a month to your savings from the day you move in or find a different house. Okay, this is the one I mentioned at the start. The year 2 payments jumps. When you buy a house, part of your monthly payment goes into something called an escrow account. That account pays your property tax. Simple enough. But here is what catches people in your first year. Those taxes are still based on what the previous owner paid, not what you paid. So if they bought the house years ago for $200,000 and you just paid $300,000, your taxes are still calculated on that old number. Then your year 2 comes. The city updates the record. They see what you paid and they adjusted the tax bills to match. You see, the fix is simple. Before you make an offer, go to your country's tax website and look up what the tax would be based on your purchase price. It's a public information. Take about 5 minutes. You see, that number, not the current bill, is what your payment is actually going to look like. So, 15% stress test. Ask the big 5 and check the real tax number yourself before you offer. If this helped you, please hit the like button. It gets this in front of more first-time buyers who need it. And please make sure you subscribe if you want the rest of the playbook broken down the same way. Next video is right here, and it covers the parts that traps people up even after they nailed the budget.